So joining us right now on how the Fed is likely to view this week's inflation data, Roger Ferguson, former Fed vice chairman, as well as a CNBC contributor. And let's just do it this way. Let's say you happen to get a phone call from Jay Powell right now, and he said, did you see the CPI numbers? What do you think I should do about that?
Look, funny way to ask the question. Look, I think the Fed is looking for trends. The market's very excited about a slight move one way or the other. The truth of the matter is, underlying all of this, the economy is strong, the labor market remains strong, and inflation is, if it's moving to the 2%, it's moving glacially. And so I think the answer is you stand pat at the next meeting, wait for more information to get a clearer view. And obviously, we also know fiscal policy is going to come into play as well. So my view is this doesn't change anything. Stay where you were with an expectation of no move at the next meeting, and then we'll see what happens after that.
Are you surprised at the market's reaction thus far? And I think it's fair to say the market is rallying on this news pretty much across the board. But then you also have this interesting sort of risk on. I don't know if it's risk on or what we're deciding this Bitcoin situation is, but as maybe a symbol or barometer of something moving materially higher just as we're speaking. And by the way, the Dow up now 670 points, Roger.
Look, I think the market is getting very sort of data point dependent, and every time it's slightly good news, they take that as an excuse to rally. As we saw yesterday, the initial reaction is a strong rally, and then that sort of fades as the reality of the trend sets in. And so, I'm not totally surprised that we see an initial strong reaction, and we'll watch the rest of the day. But I think the market overall is missing the big trend, which is, the Fed, I think, is in no hurry to cut. I don't think they're ready to raise either. And so inflation's moving sort of sideways, and I think Fed policy for a period of time is going to be on hold, moving sort of sideways with the Fed funds rate as it is today.
But then why is the market missing that? Meaning you've been saying it, others have been saying it.
Roger, I don't think the market now goes up when it thinks it's going to get a rate cut. I don't think that's changed. I think you're right because inflation is good. I think the market was just worried about inflation going back up. And if it can just sort of stay where it is, I think that's very bullish for the market, even if we don't get any cuts, as long as we don't get any hikes this year.
Joe, I think that's a fair point. Look, this may be to some degree a bit of a relief rally. There may have been an expectation that in spite of the PPI, things would be just a little stronger. And as soon as, that proves not to be the case, there's a little bit of a, wiping the brow and continuing to move forward. The other thing that we should recognize that, the market is right, that the economy is doing, pretty well, very well. We saw a bunch of bank reports this morning, all of which I think were indications of a strong underlying economy. So there's something else going on here. In addition to a little bit of a relief rally around inflation, there's a sense that the economy actually is healthy, and maybe people are holding their fingers or crossing their fingers that fiscal policy and the incoming administration won't mess things up too much, and we could have a pretty good year.
Hey, Roger, I don't know if you were listening to the earlier conversation we're having with Steve Leisman and this idea that maybe at some point, do you think the Fed actually shifts from 2% or talks about it in a more rangy way than 2% on the inflation picture? Goal, I should say, the target?
No, I understand. The question. So, look, I think the economic logic would be to say, let's think about this as a range. I was never in favor of an explicit 2% target because it's very hard to hit such a point estimate is something that's so imperfectly measured and hard to manage. So economically, a range would be smart. I think the issue is credibility. So moving from we believe in 2%, to suddenly, well, now we've opened up the range, people will scratch their heads and say, okay, if the range is now 1.5 to 2.5, why isn't the range 1 to 3? So what do you really believe? So I think they're in a bind where logically, theoretically, they should go for a range. I think political economy makes it very hard to move away from this pinpoint estimate right now.
Roger, real quick, do you think that this is a Jay Powell issue, meaning, down the line, if he ultimately is replaced, and I say down the line, when his term is up, but somebody else comes into that seat, that they can establish a range if they want without the credibility issue that you're describing?
No, I think it's an institutional issue. The 2% got built in under Ben Bernanke. It's been there at Janet, been there now at Chair Powell. I don't think the new person come and say, good news, I'm going to open up the range, because right away the question is, wait a minute, are you an inflation hawk or are you an inflation dove? You know, if that's your first move, I think it undercuts individual and institutional credibility right away.